The elephant in the room is actually silver.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We bring you exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi there, my name is Shane Moran, and I'll be your host for this week's episode. And we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets, and we expose what's really going on in the precious metals industry. So get ready for another packed episode of Live from the Vault. And we bring you the knowledge and we bring you the information that the mainstream media just will not provide. So just before we head over to the UK, please help keep spreading the word about this channel by hitting that like button right now. Go ahead, hit the like button, share this information also, and hit the subscribe if you haven't already subscribed. And if you click on that black bell right there, we will notify you as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, on our last market update, and our last episode is only 2 weeks ago. It seems like much longer, but again, we recorded that in the Chinese Golden Week holiday and ahead of what you predicted would be a large politically sought non-farm payroll beat. And while you expected the Fed to try to rinse out these fresh new gold buyers, you had also identified exactly where the central bank physical orders were situated. And once they had been hit, it would lock in the next higher physical stair-step support, and we would make fresh all-time gold highs. And this played out just as you predicted now, Andrew. This is amazing. And here we are now as we get closer to the BRICS summit next week. Can you tell us what you're expecting now ahead of this BRICS summit?
Yeah, great to be with everyone. Thanks, Shane, for gathering all these questions for us. But you know what? This the good thing is, because we face the physical market, it's not rocket science. It's just about identifying where the deliverable NSFR compliant spot gold central bank bids, not just bids, but where their buy stop triggers are. In other words, they can, if it dips, they'll buy. And if it gets to a certain level, they'll buy. And it's where they're located. Against, really, we weigh that up against the scope of how many of these led by the nose, 96% leveraged speculators can be wash and rinsed out before their synthetic supply runs into this 100% fully paid for physical gold. And it's all thanks to Basel III that we have that change in behavior. Now, thing is, leverage works well if you're on the right side, and it's and obviously it's manageable when you're not betting against a physical deliverable commodity, which can be, obviously, unless it's a deliverable commodity, it can be cash settled. But once the tail wagging the dog, 96% leveraged gold sellers run out of speculators to sell into, then they're forced to 100% fully fund these bets. And that is to back up what flows out of the casinos, exchanged for physical backdoor. We've covered it a million times what that is. And then it lands loco London as physically deliverable gold, as benchmarked at one of the two, either the AM or the PM gold fixes. Now, this synthetic gold has just been alchemized into a first-tier asset class. And so it's flowed out of the COMEX in leverage form, and suddenly it lands through this EFP mechanism into, and is alchemized, as I say, into a first-tier asset class. And that can be then employed as that kind of instrument. It can perhaps acting as a safe haven hedge on risk that runs alongside US treasuries. But regardless, these once price-setting synthetic bets immediately become physically deliverable meaning these sellers must go to the 10 times larger NSFR compliant physical foreign exchange markets to buy the physical gold. And this is the important point, at the market price to physically deliver. And this is when reality bites. And it's precisely what is forging this series of higher physical driven stair steps. So it really just doesn't matter so much about the Fed and their rigged news flows that historically enable the insider bots to bat gold and silver around at will. We'll look in some detail later, but the elephant in the room is actually silver.
Now, Andrew, just before we started recording here, it's my favorite topic, of course, silver. You said that you see a silver on a cusp of a very large breakout. Can you share with our subscribers here what you're seeing?
Yeah, I knew you'd like this subject, Shane. In fact, it answers some of the. It's funny, we were shooting the breeze a little earlier, and it actually amazingly answers some of those questions. So, we ran. I think we ran out of time last time. I was going to cover some more about silver, but following some very high level end of third quarter meetings with our liquidity provider group, what was really notable was for the first time since the end of the first quarter, silver was very, very high on the agenda. In fact, it was the main subject matter. So off the back of this, let's start by looking at silver, which, as attested to by this linked metal focus report, it really confirms what we and the COT insiders already knew. So I've linked it right here. Now, what is glaringly obvious is that the majority of CTAs who follow the likes of Bloomberg analysts and that kind of, and CNBC and all that kind of group of market analysts, and for all the wrong reasons, they haven't once reported on silver since the 2020 silver short squeeze, which was pretty hard to ignore. And these COMEX-centric speculators who actually, and we've covered this before, they drive about in excess of 75% of all the open interest, which is the borrowed casino chips, basically. They don't have any view into the underlying physical market shortages. They view synthetic silver, exchange traded funds, and shorted positions or long and short positions in the COMEX. They just look at it as another stock to be shorted inside the casino's chart-painted ranges. And while it's assumed it is the first-tier banks it's assumed that the first-tier banks are betting naked short against silver, and while they are from time to time, and I'll explain why, it's largely the speculators who we identify as the momentum traders utilizing this 75% of all the casino chips, who've been lulled into years of chasing from an insider determined pillar to an insider determined post, their ranges that the insiders determine. It is this group of synthetic traders we've labeled the cartel's useful fools. Now, whale-sized footprints evidence cartel bid pulling efforts timed to regularly milk these highly leveraged spec casino chips borrowed from the house, but just enough to keep this lucrative game running. If you're a cartel, you can do this, and it's not physically deliverable. It's not Basel III compliant yet. However, concurrently, spearheaded by Goldman Sachs and inclusive of this entire group of market-making LBMA cartel so-called professional trade, without exception, they're all betting on silver to rally to over $37 and are regularly taking the long side of bear-trapped, highly leveraged naked short bets. But what's notable is because the unallocated fiat-diluted silver market is increasingly circumventing London and being settled in BRICs-facing allocated physical form, the lines have crossed, and all the major liquidity providers see silver catching up with gold, and they are ready. The insider rig game worked well when unallocated foreign exchange silver was able to be cash settled amongst the books of the so-called LBMA professional trade. But now that the physical markets are being settled in Asia in physical form, these blinkered COMEX spec short sellers are blindly walking into a short squeeze bear trap that will exceed the scale of the 5-month $19 short squeeze triggered in March 2020. And even though that was triggered by refiners shutdowns because of COVID, the rally is being driven for the same reason, a shortage of physical supply. But this is now embedded. Siloed inside the bubble world of the casino, these blinkered silver futures traders, they failed to make a distinction between shorting a stock and hedging a physical commodity. And given the first-tier bullion banks are actually long physical silver for their own books and have largely hedged the physical positions with short futures contracts, but more importantly, as market makers, have for years been taking the long side of spec shorted options. And I'll explain that a bit more, but what is happening, they act as a cartel and have a direct connection to the physical markets. So they can allow a short squeeze to progress as long as they like. And this rig game lulls the momentums into feeling safe in creating a little alpha, largely by selling options calls, which is dangerous, and banking the sales up to 12 months in advance because they feel comfortable inside these gaslighted ranges. And yes, we've evidenced the likes of JP Morgan shorting silver. That was in March 2008 from $21 to $8. And they still do act as agents for officials to weigh on silver as part of its mandate to intervene in gold. However, ultimately, the Fed has to short cover these naked short bets by printing money to buy them back. And by acting as a key member of the so-called LBMA professional trade, the cartel, they can time these short covering triggers to their advantage. This is how the game regularly plays out. So as far as the general market is concerned, the bullion banks, which is the producers, etc., into a price rally or a short squeeze, they one-to-one add hedged shorts, mirroring basically the naked short specs. While in tandem, their physical silver positions, their forwards alongside one-to-one hedged physical assets grow in value. Then, and this is the key part, acting collusively, when they deem the naked short specs bets have reached the nosebleed levels where the COMEX open interest or the chips have been tapped out, or they've loaned out enough of these chips, the cartel pulls the rug out and uses the tricked waterfall to cover their short hedges, simultaneously raising the value of their physical silver assets. So on the occasions that silver has broken out of their preferred ranges, they've historically invoked CME margin increases, which is the cost to hold a fractionally held bet long or short. They force the shorts to actually bump up the amount of money they need to carry that position. Well, that's sufficient because it's so hairline. That's sufficient to pop the highly leveraged spec bubble. And then they cash out all their shorts at that moment, and in all cases, locking in a higher price for their physical silver assets. This is a nice gig if you can get it, but it's illegal. However, as we know, and attested to by our first-tier liquidity providers, and empirically evident in the earlier linked report, all the first and second-tier banks have been going long silver, leaning ever harder into this fourth year of an unsustainable supply deficit. I mean, Goldman Sachs has been going long both gold and silver since 2020. This activity significantly picking up in January 2023, following FX gold being reclassified as a first-tier asset class.
I think this is where it helps to have a look at the charts, which we have stripped down really just to show the major inflection points. And while we're talking about silver, and that FX silver is not NSFR compliant, i.e. when it lands in an unallocated form in London, it is not necessarily deliverable. Its relationship, though, between to the gold price, and basically a $1,250 gold rise in price between March 2020 at $1,450 into really our September, October highs. And then we look at silver, and yes, it's rallied, but not to the extent that gold has rallied. And what it does is exposes really the cartel synthetic silver price as grossly undervalued. Now, while silver has risen $21.50 from its March 2020 lows, Western-facing traders have been gaslighted into betting on around an 80-to-1 ratio as fair value. Yet under the noses of COMEX options traders repeatedly betting against silver by selling calls against silver, they are unaware that silver is now being largely settled outside the cartel's ring fence and is imminently coiling for a test and breach of the 2011 $50 highs. To even think that this is a fair value just shows you how synthetic this entire casino market is. Now, one thing for sure, we're going to demonstrate this, the cartel is actually extremely long physical silver and is not putting a single ounce on sale at current levels. And as we've demonstrated or identified before, the COT sweet spot to trigger ringing the register on this huge aggregated naked short spec bets is at 32,750 to 33. Now, the 32,700 spot high after non-farm payrolls came very close to tripping off these bets. And although it was stick saved, and bearing in mind what we were looking for was a pit close above that level that we just identified, and it failed to do so. This was clearly the moment they waited for, the exact moment that London cleared for the day. That was after the PM gold fix. And to then literally use an air pocket of thin market to really just try and take this, stop it breaking out. It wasn't the timing they wanted. But what we're saying is that the spec shorts are close to being severely rinsed by the commercials on, and this is where a lot of the speculator written calls sit. And this is literally, they're very, very close to being, again, because the commercials are on the long side of spec written calls. And we really need to explain what that really means.
Now, Andrew, you've covered talking about options here. You've covered this disruptive option strategy in previous episodes of Live from the Vault, but it's important, I think, to understand it. Can you briefly outline this complex strategy so our members can get a better grasp on this strategy?
Yes, Shane, it's important to understand because the unwinding of this price containment strategy is going to trigger the short covering catalyst that will drive silver to reset the ludicrously, purely synthetic 80 plus or minus 80 to 1 ratio. I mean, it's currently taking 84 ounces of silver to exchange for 1 ounce of gold, when natural law says it should take 12 ounces of silver to buy 1 ounce of gold. And what that would essentially make silver $200 per ounce just to catch up to today's still rising gold price. And this is the spot price of gold. And really, to just really sum up, writing unhedged calls, what it involves is unprecedented leverage. And when it goes wrong, losses can quickly exceed multiples of what these specs bet when making these bets. It is these options traders who will be the first to get carried out feet first. And guess who's on the long side? every single bullion bank, all of whom have accrued large physical gold and silver positions. However, given that it is these same banks who act as agents and have been insured against losses by the Fed, exposed to massive OCC-related foreign exchange bets. That's Office of the Comptroller. It's in a report. We'll look at it in a little minute. But and these bets are against silver. And it's the unwind of these extremely offside official FX silver bets that are being stick-handled by JP Morgan that will be the driver that revalues silver. Now, with bullion banks long physical, liquidity providers assess that once silver is quote-unquote allowed to run, it will be driven far in excess of the November 50 highs. In fact, their estimate is $53 before any major resistance. At this point, good riddance to the bankrupted, gaslighted momentum traders controlling over 75% of the synthetic axon. Now, clearly, if you're making a market, you need somebody, a useful fool, to take the other side of that trade. Even if you're going to only win 5% of the time. As a market maker, clearly the casino wins 95% of the time. Now, there are a ton of clues here. And if we drill down into what we captured at points intraday, it really illustrates the disconnect. Now, this is a live chart. And as you can see, what we're looking at here is the spot premiums. This is the spot price. This is the spot premium, basically to illustrate. I'm just really trying to illustrate that this is the spot premium to settle the still in delivery October liabilities. And you can see that they're being forced to pay. And we've seen it consistently above $20. And we see it into rallies and into dips. We see it expanding even more. But this is the actual premium to deliver what you still haven't delivered yet in the October contract, which is about to run out in by the end of this month. Basically, that's the last day to deliver. And we kind of looked at this in the past, where why would you hang on to this kind of risk? Well, again, you would think they hang on to it because they think they can get the price down and exit these positions at a discount. But it's not happening. And it always beggars the question. You could discharge this liability on the very first day of October, on the first day of delivery. If you drag it out, we looked at this last time in the last episode, why would you drag it out? Because you're incurring friction, you're incurring carry costs, storage fees, etc., etc. So clearly, this is a huge mistake. So this is what costs you on top of the spot price to get out of this contract or settle it in the NSFR compliant gold market. Now let's look at silver. There's an October contract, and we're looking at we've seen it. We've seen it as high as $1.43. I'll show you a snapshot of that in a second. But this provides much clearer evidence that something is extremely awry with the counterintuitive paper to physical spread. As I say, we captured it in the Asian sessions at around 84 cents. And that has endured around 60 to 80 cents. I mean, this is huge. I mean, you're talking about a big spread to get out of these foot-dragged contracts. But somebody got caught paying a huge $1.43 spot premium, and that happened at the yes, you can see it here. I marked to the exact point that happened. That was exactly the PM gold fix hour, and what we saw was at that point $1.04.3 per ounce to get out of that contract. The October contract we're talking about, the in delivery October contract. And while this had settled at the close, you could see they managed to square up some positions. But if you think about it, somebody got caught paying this premium. And they dumped exactly 10 contracts at this point. And that is a $52,000 premium over the ability to cash settle these lots. So as of last night, with gold prices significantly higher, and as of last night, I mean, the prices are over $1 higher than they were on Friday, and there's still a massive spot premium to pay to exit these delivery obligations. It's just that nobody looks at this stuff. It's so blatantly obvious if you care to look. And obviously, being on the physical side of the market, that is our sole focus. And as of last night, there's still four lots still to square up. So what we're seeing is into the unprecedented large backwardations to spot, same as we've seen in gold. This presents a physical buyer the huge discount to lock in the October contract for a discount for spot delivery. And liquidity providers assess this was likely on Friday an insider bank creating, then capitalizing on the spread. Either way, it's tightening up supply. And despite all this gaming, after silver tried to break out, we actually only evidenced two fixes in silver sub the 31 level. And that was despite employing the full court press against the CTAs. Why? Because we saw massive Indian, Chinese, and also reported Russian demand, which has capitalized on the dips sub $31, sufficient in size to swamp the sucked-in CTA supply to force insiders to one-to-one go long against them to offset the draining of the available above-ground supply. And talking of Russia, I'll get the link put up here. Into recently published Russian mandate to add silver's reserves to their state-held funds over the next 3 years, Russia will be withholding a sizable chunk of the 40 million ounces they produce annually, further tightening up supply, as can be seen on this September the 30th Interfax report, which I meant to show you last time. So what we're saying is, into deeply counterintuitive supply-demand fundamentals, silver is coiling tightly for a very large physically driven move higher. And as I say, a third test of these short stops, a third of the cartel short stops above 32,750 will leave far too speculators to sell into. So that'll be on its way to hard test the 50-time all-time highs. And you even see now, as we said last time, Goldman and a lot of banks now seeing spot silver at $37, and we see it moving above 37 quicker than most people predict.
So, Andrew, as we look further out into this quarter, gold is doing what you said it would do, carving out a higher physical stair step to rally from. As you mentioned recently, this leaves the Fed, the only central bank of all the central banks, it's the only one still betting against gold. Doesn't it leave them in a real difficult position?
It sure does. And as far as gold is concerned, we've looked at why the Fed's most likely way to extricate themselves from billions of naked short OCC, and this is Office of the Comptroller, technically NSFR deliverable gold bets. And what it would be if push came to shove, they would have to revalue gold to market so as to stem really a current avalanche of US treasuries being dumped for gold, which has become so prevalent. And note the World Gold Council advising Swiss pension funds to sell bonds to buy bullion. It threatens to accelerate the repatriation requests. And we looked at it in the past as well, where it's undoubted that the Fed has their 8,000 odd tons of treasury held gold. Is undoubted that it's rehypothecated to one degree or another. And so really, again, this revaluation process would actually avoid them having to bear the cupboard. So now, furthermore, I think the Plunge protection team has a mandate to try and cap discount gold ahead of the BRICs Kazan summit. which commences on the 22nd, which is when this is published on Friday. That's 2 sessions from when this episode is released on Friday. However, as we've assessed in our last episode on the 2nd of October, given the physical markets are being determined and settled outside the synthetically determined 96% leveraged LBMA CME ring fence, the scope of these sell attempts are limited to how many 96% leveraged CTAs that can be rinsed out without officials digging an ever deeper hole, which will ultimately have to be squared by fully funding the exchange traded funds that escapes the exchange for physical, that'll include ETFs as well, but really what escapes the back door of the NSFR of the COMEX into the NSFR compliant physical markets for delivery.
Now, just to reiterate, we're using very stripped down charts here, and basically, if you remember, we're recording this between the AM and the PM fix, as we do every time. This is where we recorded it on the 2nd of October. This is where we recorded it on the 18th of October. Let me just pull this so you can see both of those. There. So I'm just giving some feedback from one very reliable first-tier liquidity provider. They're indicating the current round of counterintuitive official selling in gold futures, and this is gold futures. We adjust, this is spot plus the gold futures premium, which is around $15 to $16 right now. So what they indicated was, and of course the action happens in the futures, that's why we track it. This counterintuitive official selling commenced directly after gold forged an all-time fresh spot high, which was 2685.50. This is 2708.70 in futures, and that was at the pit open on the 26th. Note the timing, and these footprints evidence an official move to protect billions of dollars of extremely wrong-footed and technically NSFR deliverable official bets populated unidentified in the current OCC report, the Office of the Comptroller report. Now, following JP Morgan inheriting Bear Stearns short positions back in 2008, and if in silver, that was a move basically from around $21 all the way down to 8.4. And in gold here, they were in, obviously, Bear Stearns had a huge short silver and gold position. And into the 2011 highs before we saw a sell-off, we actually evidenced, and it's clearly in all the reports, if one can go back and look at it yourself, JP Morgan was holding as high as over 99% of all precious metals derivatives. The current report still evidences JP Morgan controlling 58%. And we know they act as agent for officials. They are long for their own book.
Now, the latest report by Wall Street on Parade, linked here, does an excellent job of drawing attention to these long-standing insider-held OCC bets. That is, Table 21 in the latest OCC report shows that all commercial banks, savings associations, and trust companies with derivatives accounted for $483 billion in precious metals contracts. Now, of that sum, JP Morgan Chase Bank holds $281.7 billion, or 58%. As I said in the past, they've had more than 99%. So you can see that in these links. Now, given that these are foreign exchange bets, and that since Basel III regulations were imposed in 2023, foreign exchange gold is now technically NSFR compliant, and that the BIS short covered all their derivative bets in November 2022, these residual bets are strictly non-compliant, with gold reclassified as a global first-tier asset class, and that the settlement process is increasingly being determined by the BRICs facing physical markets. Now, these bets pose a major problem for the Fed, the sole central banks, as you say, still orchestrating these undeliverable naked short bets. Now, following our efforts to bring this huge too big to fail bank default tail risk to a question that we successfully raised in the House of Commons on the 8th of July 2019, still on record there, it led to our meetings with the Treasury and the now Bank of England Governor Andrew Bailey when he was head of the FCA. And it put the Treasury and the Bank of England, who had been ignoring my earlier warnings, on record to actually answer the questions, focusing on these multi-billion-dollar bets, the ones that we're drawing attention to again now, risking another too big to fail bank bailout.
Now, Andrew, I recall on one of our Live from the Vault episodes that you were outlining these questions that you had raised with the UK Parliament there. It really exposed just how little the regulators knew about the risks facing the too big to fail bullion banks. And are there any updates here?
Yeah, Shane, yes, it was absolutely alarming to hear how little the FCA, the regulator of all regulators, knew about this massive unreported smoke and mirrors backdoor, which is these over-the-counter, not listed or traded on an exchange derivative positions of the largest US banks and the ability to not report billions of dollars of unreported 14-day forwards to be rolled ad infinitum over and over and over again without reporting them. So given these so-called OCC derivative assets are employed as hedges, underpinning the ETFs and the exchange for physical conduits, communications with the Department of Justice, the CFTC and the LBMA were opened up. However, so deep are these derivative bets, to buy time to exit these wrong-footed bets, a word salad was concocted. So, and really, I have it. Well, I'll read it in a second, but because, I mean, this is unbelievable. As we've drawn attention to on a regular basis, while the market focus is steered towards the reportable but rigged, deliberately stale dated COMEX Casino COT report, which is always delayed, it's marked on a Tuesday, it's not released on a Friday. By the time the next one comes, it's ludicrously out of date on purpose. This only presents the futures leg. We've talked about this multiple times. It only represents the futures leg of a complex multi-trillion-dollar asymmetric structure where these same actors don't have to report the extent or value of the NSFR compliant over-the-counter leg that is supposed to benchmark these published so-called hedge positions. Now, the CFTC accepts the full regulated CME's voodoo reporting at face value. And if the head of the FCA admits they have no visibility into the unregulated over-the-counter leg of the asymmetric trade, what use are these COT reports? So, in summary, what was the OCC's solution to this? So, rather than tackle the problem head-on, they reclassified these OCC bets from a deliverable FX position, which it used to be reported as, into this very spurious heading. And it says, quote, under SA, CCR gold derivatives are considered precious metals derivative contracts rather than an exchange rate derivative contract, resulting in an increase in reported precious metal derivative contracts compared with the prior quarters. Yeah, again, no sugar, Sherlock. Once again, honestly, what? Yet it's still actually used as a benchmark. This is unbelievable stuff, and it's happening right in front of the regulator's eyes. But this hasn't gone unnoticed by the BRICs-facing banks and the dealers who recognize that the Fed is limited to what can be squared on the synthetic markets into a dwindling volume of spec open interest. In other words, chips borrowed from the casino. The BRICs-facing central banks are now busy alchemizing the Fed's efforts to unwind these OCC bets, and they are trying. And this is particularly pertinent as we head into Kazan just 2 sessions from now, especially as word had leaked out that the PPT has had a mandate to try and cap and discount and short cover into CTAs ahead of gold breaking out after the BRICs Kazan summit on the 22nd. And we see rallies we've seen rallies in every single currency, gold currency, but we're seeing this capping. They're desperate. However, given the physical markets are being determined and settled outside the synthetically determined 96% leveraged CME ring fence, the scope of these sell attempts are limited. And I make a big point of this. When you see a drop, when you see a dip, it's limited to how many of these 96% leveraged CTAs can be rinsed out inside the casino. And this is becoming harder to hide in the rigged COT reports, where, just as we expected, swap dealer insiders acting for the Fed, all the bullion banks are long for their own book, by the way. They have tick for tick short covered into the tricked in, bid pulled CTA long stop rinse this last week. And notably, despite all the beneficial tailwinds, there was insufficient non-sticky longs to rinse to get downside traction.
But as you highlighted, Shane, in the bigger picture, the current paper to physical disconnect is not dissimilar to the Fed's extreme wrong footing in mid-February here, where they tried to short cover bets sub 2,000 spot. And while this upside central bank physically driven momentum was bolstered on the 1st of March by the PBOC strategically sanctioning the launch of the Shanghai Futures Exchange, that 2 weeks later, the launch of the BRICs currency launch in 2 weeks is uncannily similar to, and liquidity providers assess 3,000 gold is likely to follow faster than we originally expected. I'm not saying there's not going to be a fight between now and then. And looking post what we'd recorded last time between the AM and the PM fix, if you remember, we had non-farm payrolls coming up, we had jobless numbers coming, and as expected, just as we thought, it was no surprise to see to evidence the headline non-farm payrolls and jobless numbers being rigged into politically sought beats. Officials and insider agent banks are leaked the data for major news events well ahead of time. And I can reference the CFTC Commissioner Bart Chilton, and we've outlined it in the past, how he'd said how leaky these rooms were, how nobody took the phones away from people. It's a leaky setup. But the Fed already has that data, and the insiders have that data days in advance. And given the Fed is extremely wrong-footed, naked short gold and related silver, these predatory actors were culpably involved in positioning short ahead of the release in the expectation they could rig a large stick save sell-off against an expected CTA sell-off. That failed. However, despite the known large beats, these predatory actors once again ran into extremely large central bank sovereign gold and silver demand, completely thwarting their efforts. In fact, so large was the physical demand sub-spot 2650, which is the equivalent here, 2665.90 in futures. They had to be sure that they didn't hit the central bank sovereign bids we had specifically identified that was sitting at the gold futures equivalent of 2618. It happens to be 2616 because the contango contracts each day as we get closer to the expiry of this December contract. But we knew this would be front run, and indeed it was front run. But liquidity providers assessed these efforts ended up still digging a deeper T+1 delivery hole, meaning that when we see the fixes, it forces a T+1 delivery, the unwinding of the leverage we talked about. It's a deeper hole for them to climb out of. Finally, I thought it'd be helpful to share the large market view tracking gold as benchmarks against all the gold currencies since 2008, the crisis in 2008. And this is particularly pertinent as because we're looking at a major crisis similar to this, but even worse than this. So basically, let's just have a look. I mean, this is gold. This is the price of gold measured in different currencies. So if you'd bought pound, you'd be up 531%. It's currently at 2,055.84, having made fresh highs over the last couple of days. Yen gold is about to make fresh highs, and it looks like it's knocking on the door. Euro gold has made fresh highs again over the last couple of days. That's 406% up. The dollar against gold is up 320% as per spot gold. Now, the yen or CNY gold is now making fresh highs on a day-to-day basis. Currently, when I captured it, it was 19,048. It's actually higher now. Then that's reference. This is the home price index, as opposed to the US. This is GB home prices, but it's all fairly similar. That's up 505%. Sorry, that's up 51%. So basically, US dollar index is up since 2008, just 11%. The pound against the dollar is down 35%. And it's a bit unfair to compare Bitcoin because it actually only came online. It didn't come online in 2008, but never mind. It still doesn't perform well currently. So I just thought it would be interesting to put things into perspective. We have all-time highs being made, and this has actually largely been driven by CNY gold over the last few days. And what does that bring us back to? The last time we saw massive CNY buying. I'm not saying that is definitely it, but I've tentatively marked that as the next driver. Only by the time this gets published on Friday, there's just going to be 2 sessions to the BRICs launch. Now, while the BRICs launch, it won't be an overnight sudden move. What it will be is a steady move out of the dollar to settle all commercials, currencies, goods, commodities amongst the BRICS members in currencies other than the dollar.
Our next episode will follow a week after the BRICS summit, and we'll drill down into what the various actors are up to. And with a little luck, World War III won't have been triggered, but either way, gold and silver are headed into at least 3,000 and into the third and final test of short sellers' resolve at 32,750 or 32.75. We need that pit close above there. The next silver rally will be driven by the bullion banks, long silver in massive size. And guys, this brings us to the closing question. How much physical gold and silver do you own right now?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical, make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled out there. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. And please help keep spreading the word about this channel by hitting the like button. That really helps the channel. Share this information so more people can find out about it. Subscribe if you haven't already done so. And if you click on that bell right there, the black one, we'll notify you as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.